Welcome, everyone, to a brand new explainer. Today, we are putting a regional bank through the absolute ultimate stress test. We like to call this the Guru Gauntlet. Basically, we're going to take Peoples Bancorp, ticker symbol PBO, and analyze it using the exact battle-tested investment frameworks of legendary investors, Warren Buffett, Peter Lynch, and Benjamin Graham. And then, just to be sure, we'll back it all up with some rigorous hard math, running discounted cash flow and dividend models based on their latest 2026 financial data. Okay, let's dive right into this.
Here is our roadmap for the explainer. We'll kick things off with a quick company snapshot, then we'll run PEBO through the Buffett, Lynch, and Graham lenses. After that, we hit the math lab for the DCF analysis before wrapping up with our final synthesis.
All right, Section 1, the PEBO Company Snapshot. Let's see what we're working with here.
To set the stage, as of the end of the first quarter in March 2026, Peoples Bancorp is trading at $38.40 a share. That gives them a market cap of roughly $1.36 billion. They're a solid regional bank with a footprint stretching across Ohio, West Virginia, Kentucky, and the D.C. area, holding about $9.6 billion in total assets. Now, they just posted a really strong Q1 with 81 cents per share in earnings. But honestly, the big story, the major catalyst we need to be watching, is their recently announced acquisition of Citizens National Corporation. This move adds $686 million in assets and seriously deepens their presence in Kentucky. It's exactly the kind of strategic growth catalyst we look for before running our valuation models.
Moving right along to Section 2, the Warren Buffett lens. So what does the Oracle of Omaha actually look for in a bank? Well, he demands a durable economic moat and consistent owner earnings. And looking at PEBO's recent numbers, they absolutely hint at a massive competitive advantage. In Q1 2026, they posted a 4.16% net interest margin. Let me tell you, for a regional bank, that is fantastic. Plus, their non-performing assets are sitting at a remarkably low 0.41% of total assets. Translation, they're making really good money on their loans, and crucially, the people they loan money to are actually paying it back.
Now, you might be wondering where that high net interest margin is coming from. Well, in the banking world, your moat is almost always defined by your deposit base. How cheaply can you acquire the money that you're then lending out? PEBO's cost of deposits is sitting at just 1.76%. That is significantly below the 2.09% average for their peers in the $1 to $10 billion bank universe. Having this sticky, low-cost deposit base gives them incredibly cheap funding. It's exactly the kind of deep structural advantage Warren Buffett loves to see.
And then, check out this beautiful, consistent stair-step growth. This totally satisfies Buffett's strict requirement for reliable owner earnings. What you're seeing is PEBO's tangible book value per share over the last few years. It just steadily climbs from $16.23 back at the end of 2022 all the way up to $22.95 by Q1 2026. This rock-solid growth in equity value, stacked on top of their low-cost deposit moat, means PEBO passes the Buffett test with flying colors.
All right, Section 3, the Peter Lynch lens.
The legendary Peter Lynch loved to categorize companies into different buckets so he could understand their overall trajectory. For PEBO, just looking at their continuous, highly strategic M&A history paints a really clear picture. They acquired Premier in 2021, Vantage and Limestone in 2022, and now Citizens National in 2026. Because of this, PEBO fits perfectly into Lynch's stalwart category. These are your ultra-reliable companies that provide steady, compounding growth, usually fueled by really smart, accretive acquisitions.
Let's dig into the specific metrics Lynch would care about. Right off the bat, PEBO offers a super attractive 4.84% dividend yield, and they literally just announced their 11th consecutive annual dividend hike. Awesome. Lynch also loved seeing insider buying because it proves management has skin in the game. Well, according to recent filings, Director W. Glenn Hogan recently stepped up and bought 1,000 shares. On the institutional side, the heavyweights are already parked here. BlackRock, Dimensional, and Vanguard all own significant chunks. Finally, if we take that Q1 EPS of 81 cents and annualize it, we're looking at a PE ratio of roughly 11.8. Lynch would likely view this whole package, the yield, the insider confidence, and that very reasonable valuation, as a highly compelling setup.
Up next, Section 4, the Benjamin Graham lens.
For the undisputed father of value investing, Benjamin Graham, it is all about capital preservation. He used a notoriously strict defensive checklist. Think of this as a gamified scorecard for risk. Adequate size? Pass, with a $1.36 billion market cap. Strong financial condition? Pass, an amazing 98.9% of their loans are current. Earning stability? Pass, they've been remarkably consistent. Dividend record? Definitely a pass with those 11 straight increases. And moderate valuation? With that PE of 11.8 and a price to book around 1.6, they pass yet again. PEBO literally runs the table on Graham's defensive filters.
And because they managed to pass that brutal defensive checklist, we are officially permitted to use Graham's intrinsic value formula. Let's explicitly state our assumptions for this math. The formula is the square root of 22.5 multiplied by earnings per share multiplied by book value per share. We are going to take that Q1 EPS of 81 cents and annualize it out to $3.24. And for the book value, to be as conservative as possible, we're using their tangible book value of $22.95.
When we crunch those numbers, the square root of 22.5 times 3.24 times 22.95, we arrive at an intrinsic value of $40.90 per share. With the stock currently trading at just $38.40, Benjamin Graham's strict, historically conservative formula is explicitly telling us that a solid margin of safety actually exists right now.
All right, Section 5, DCF and other models.
Let's leave the guru philosophies behind for a second and step into the strict math lab to build a discounted cash flow model. We need to lay out our explicit assumptions here. According to Trefis data, PEBO has a very strong free cash flow yield of 9.6%. We're going to project that out over a 5-year forecast period. To discount those future cash flows back to today's dollars, we'll assume a standard banking industry average, weighted average cost of capital, or WACC, of 10%. And for the terminal value, what happens after year 5, we're using a very conservative terminal growth rate of 2%.
This sensitivity table is a great way to see how the fair value shifts depending on our cost of capital and growth assumptions. Just look right in the middle at our base case. A 10% WACC and 2% terminal growth lands us at a fair value of $38.10. And this is wild. That is almost exactly where the stock is trading today at $38.40. Essentially, the raw DCF model is telling us the market has priced the stock practically to perfection based on its current cash flows. But if we quickly layer in a couple of other valuation models, they definitely support this baseline. Looking at comparable multiples, PEBO's 11.8 PE is actually slightly below the historical regional banking sector average, which normally hovers around 12 to 14. And if we run a dividend discount model, the stock's 4.84% yield, paired with management's expectation that the Citizens National deal will add 5.6% to their EPS by 2027, suggests the stock is, at worst, fairly valued and at best, slightly undervalued.
Finally, Section 6, Synthesis, and our final verdict.
We have successfully run the gauntlet, mixing qualitative moats with raw cash flow math. Let's bring it all together. Warren Buffett's framework signals a buy, totally driven by that incredible low-cost deposit moat and consistently growing book value. Peter Lynch leans toward a buy or a hold, loving the stalwart status, the accretive M&A, and the insider buying. Benjamin Graham's math explicitly signals a buy, giving us an intrinsic value of $40.90, which provides that much-needed margin of safety. However, our rigorous DCF base case lands right at $38.10, signaling a hold, implying the stock is currently trading right at its fair value.
Now, to stay perfectly objective, we have to weigh these absolute strengths against the reality of the banking sector. PEBO is undeniably highly profitable. Their net interest margin of over 4% is elite, their deposits are super cheap, and they have a great track record of rewarding shareholders. But at the end of the day, they are still a regional bank. They face inherent, unavoidable risks regarding interest rate sensitivity, and any broader economic downturn could definitely trigger commercial loan defaults, no matter how tight their underwriting has been up to this point.
So this leaves us with the ultimate question for you. The guru frameworks see a high-quality business trading at a slight discount, while our raw cash flow math suggests it is priced to absolute perfection. At $38.40 a share, does Peoples Bancorp offer the margin of safety your personal portfolio demands, or is the market already fully aware of just how good this bank is? Thank you so much for joining me for this explainer, and keep learning.